everyone, it's Valentina Sanchez Cuenca from the Bird Jobs Report. Welcome back to another of our weekly live shows with Craig Shapiro and Larry McDonald. Since 2010, we host an institutional live chat on Bloomberg with more than 660 investors in more than 20 countries. If you're interested in joining us or learning more information, please email Tatiana at thebirdjobsreport.com.
All right, okay, we're live. Hi, Larry McDonald here. Thank you so much for joining us. We're back with The Lens, Friday mornings, 11, 12 Eastern Time. Got a great group here. Craig Shapiro is in the house again. Got Lauren Rometta from Bowbridge. Want to bring everybody up to speed as to what's been happening this week. We've had a big move in this multi-strat unwind. We did a video last night. It's got a lot of attention. Very end of the day, figure out, what is the true liquidity or float in stocks. And when you have so much passive asset management capital that's creeping higher and higher and higher every year, if you think of like how many shares of Costco that BlackRock, Vanguard, and State Street control, and then if you think about passive flows into stocks every month, and then if you think about buybacks, the true liquidity, the true fundamental liquidity in a lot of equities is very mysterious and very small relative to what people might think is a float. If you look on Bloomberg, there's a float of a stock, but that float's very deceptive because a lot of the shares are held in passive funds. And so the multi-strat hedge funds, what they've been doing in recent years, and they're getting bigger and bigger and bigger. The strategy's grown to the point where it's really influencing markets in a very strange way. And that's why we're seeing a lot of these. If you go long Costco, short the index. If you go long Facebook, short the index. You can, because the true liquidity on these equities is very low, you can push stocks to crazy extremes. And now when you have one or two pods blow up on the street, that knocks out potentially, 24 other companies or hedge funds that have the same strategy on. And that's what we've been going through. Let's go to the slides, Jose. First of all, Lauren, what I wanted to point out here is you notice in August, it's that smaller rectangle. In August, the momentum blow up was nowhere near as big as it is this time around. And so this is a statement on the presentation here around how this is really an equity-driven sell-off, whereas in August, when we had the yen carry trade blow up, it had a lot more to do with credit. And this speaks to the pod unwind and, this big unwind that's going on around the street where, one or two pods go down. And then you're talking about 10 to 15 to 20 other hedge funds that do the same thing, all go kind of unwinding at the same time. Next slide, Jose. Hey, Lauren, so walk us through. You see how Lauren here in August, see how the credit move wider for high yield was a lot bigger, right, relative to now. So are you seeing much contagion from this equity sell-off into credit?
Leading up to this week, credit markets were much more benign and relaxed, where the degrossing that you're speaking of in the hedge fund pod community was far more impactful in the equity space. This week has been a little different, where the CCC part of the credit market has widened out significantly over on a month-on-month period. We're about 150 basis points wider, and that's where the bulk of the widening has been concentrated. So you haven't had a systemic widening in high yield spreads yet. It's been fairly concentrated in the CCC part of the market, which you would expect in something that's not much of a solvency risk. And right now it seems to be more technical, tariff-driven re-ratings of future earnings, not a solvency question. Now, that could change if the drawdown in equities continues, but it definitely is a scenario where equities are leading credit right now.
Yeah, whereas the last 10 years, most of the time, credit leads equities. I think that because of this pod unwind, the multi-strat hedge funds, now equities are more so leading credit. One of the things we talk about in our book, How to Listen When Markets Speak, is when triple C's, how to listen to the market speak here. When triple C's outperform, it's typically a very good sign for equities, and that's been the case for the last, much of the last year. But when triple C's, and that's your tertiary credits, and that's we talked about the last 2 weeks ago. Craig and I talked about your tertiary financials, your subprime lenders who are massively underperforming the XLF. It's a classic canary in the coal mine. Your Synchronies, your Affirms, and so those tertiary financials were underperforming for like the last month, way before the market rolled over. Lauren, in terms of triple C's, and that's the junk of the junk of the junk and high yield. When did that underperformance start? Is that more this week, or is that has that been really kind of working through the market over the last month?
It's been about 3 weeks. And one thing I think that's interesting in your chart is, I've always believed that technicals precede fundamentals in markets. And as the credit spreads in high yield, you're looking at almost if you look at your chart, you're looking at over an 18-month period or so, if you zoom out a little farther, of a potential large double bottom forming in high yield spreads. And that, would be a pretty negative indicator for the future growth trajectory. But for right now, it still looks like a scenario where it's an equity earnings growth revision, not a contraction.
So Craig Shapiro runs our Discord room. So we have a Bloomberg chat with hedge funds, pension funds, mutual funds around the world in more than 20 countries. Craig runs the Discord room. If you want to join us in Discord, it's Tatiana. Craig, in your conversation, what's the ultimate takeaway? People are trying to figure out how much of this grossing is left on the table.
Yeah, I think people want to also understand what is the next move, right? And so we've seen this degrossing. We've seen it in the pod shops. We've seen it from the vol control funds. We've seen CTAs go from basically max net long in the middle of February to modestly net short now. And so, the systematic flows have really reversed and have sold down this rally. Hedge funds have degrossed. And so the question from here is, are we going to see a releveraging as volatility gets sold down and markets come under control? Or are we going to get another wave of selling from the more fundamental community because of the things you talked about, the negative earnings revisions, tariffs, uncertainty, and a slowdown? And so I think we come into a pretty crucial week next week. It's options expiry week, and we have a Fed meeting. I think there's been an expectation that with some of the soft data slowdown that we've observed, that the Fed maybe would signal, obviously not at this meeting, but that in future meetings, maybe as early as May or June, that they'd be willing to cut rates if this soft data turned into a hard data slowdown. If they don't signal that, then I think we have a larger worry, coming our way, because
the funds, the companies that warned over the last 4 days, they go across what, Craig? Airlines, transports. I mean, isn't it like 15 companies?
Yeah, I mean, it's been airlines, rails, a lot of low-end consumer names. And so you're really starting to see some of the strain in the lower part of the K-shaped economy being stretched. Real income growth is slowing. Maybe overall inflation is starting to come down, but prices are still incredibly high. And so average consumer, is struggling, and more so. And with some of the uncertainty from Trump regarding tariffs, job security uncertainty is starting to creep in as well. And that started to show up in the NFIB survey and some of the regional PMI employment data stuff. So there's angst right now in the economy from consumers and businesses. And until we get some certainty from Trump on the tariff regime, which may come as early as April 2nd when reciprocal tariffs come in and we understand the lay of the land, but it's more likely that it's going to take a few more weeks or months to really understand how serious, how other countries are going to react, and what to do from here.
See, that's why Lauren Rometta, I've known Lauren for 20 years. Lauren's one of the top credit minds in our chat. Lauren's made phenomenal contributions over the last, over the next couple of weeks. It's going to be extremely important to talk to people like Lauren, because what you're talking about is when you go from, so think of the regional bank crisis of 2023. You had this shock, and then you had a big fiscal and monetary positive response. And the fiscal response was huge, massive fiscal expansion in the United States in response to a kind of an event. Now we have another event, this pod blow up. And then, let's go back to August. Same thing. We had a yen carry trade unwind and an enormous fiscal response to that expansionary. Lauren, now we have another event, so our third one, where it's degrossing, a massive risk off, but we're looking at a pretty substantial fiscal contraction, and a Fed that's kind of not giving much direction. Lauren, do you have some slides you want to show in credit, like that you want to talk about?
Sure. There's a few. The one we were talking about is the triple C performance.
Okay.
Let me share my screen.
So the next couple of weeks, you want to be watching credit like a hawk, because if credit starts to underperform equities, Lauren, that's a sign that we have, Houston, we have a problem on the economic front that's probably going to bring the equity market down.
No, that's a good point. And these slides I put together earlier in the week, and in the last 2 days, the triple C part of the market has gone about another 50 basis points wider. So you're looking at what this is showing is the change in spreads from about a month ago in the blue bar, and the orange is a day over day change. So triple C's from Monday were about 115 basis points wider. That's gapped out by another 50 this week. So as that begins to transfer into the system, that tightening of financial conditions will be definitely in front of Jay Powell and the Fed, because that's, the stock market drawdown can have a much greater impact on financial conditions, as we've seen with the Fed going to 5+% and financial conditions remaining pretty easy through all of that. And if you think about the top 10% of the United States accounts for about 45% of U.S. spending, that top 10% also owns about 90% of U.S. stocks outstanding. So if a drawdown of 20% in the Russell and 10% in the S&P, that negative feedback loop can become its own tightening policy, which will impact spending and have a knock-on effect on hiring. So that's really the next leg here that you guys have been speaking to, is the negative feedback loop, and that will manifest itself through first triple C credit, but then what begins to happen in the double B space. And right now, double Bs have only moved about 50 to 60 basis points wider, but they popped out again in the last couple of days. So it's working its way. The negative feedback loop is working its way through credit. And that's something that currently it's not systemic in any way. And I'll move to another chart that'll just show the total move that we're talking about over time. And this is a very wide lens going back 20 plus years. And if you look at where credit spreads are relative to where they were in 22 and versus COVID, we have quite a ways to go before this becomes more systemic in nature.
And Lauren, you've been talking to hedge funds and family offices that have been coming into you, trying to structure, positive carry trades that would benefit from tail risk, right? Are you seeing more and more of that kind of interest over the last couple of months, even before this, right?
Definitely. We saw some pretty good buy signals in CDS spread terms.
And so that's people that want to buy default protection.
Yes, those were triggered 2.5 weeks ago when we were around 300 basis points. And speaking earlier about technicals preceding fundamentals, that's one of those instances. But there is a demand for tail protection and portfolio protection, and that started even before the tariff saber rattling or the tariff construction, where credit spreads were highly asymmetric. If you look at high yield spreads bottomed around 260 basis points in January going into February, and that's the tightest since going into the subprime crisis. So the asymmetry in high yield was extremely poor, and you definitely had conversations with
Well,
family offices and funds who want to take advantage.
when you say the asymmetry in high yield is very poor, what are you saying there in
Uh,
English?
the upside versus the downside, the skew in the market definitely favored either a high cash position from a real money perspective, or long convexity, or just outright short risk, or short credit spreads for a potential widening event, where the ability for spreads to tighten much from this point is very limited, and the likelihood of widening might be low, but the symmetry is in your favor, that you're looking at a potential 5-to-1 type scenario where credit spreads going 80 wider versus 20 tighter is what you're structuring and trying to capture, or your risk reward profile.
And what's amazing is you were saying, you and I were on the phone with a hedge fund maybe 3 weeks ago, or I think it was a large family, and you're actually getting a positive carry on some of these trades.
Yes, that
Normally if you short high yield, it's a negative carry, but then things were, how did that work?
the riskier segment of the market became so tight to the index that the carry profile of the trades were positive, but that's moved now. But
so you could short the market, you could short the credit market and get a positive carry
in those instruments, yes.
In 30 years, 20, 30 years, have you ever seen something like that before?
Not at these spread levels now.
And what are your signal? I know you were short forward. Any other tertiary kind of like potential fallen angels that you're looking at?
Not. I still think we're not in a systemic credit driven environment, so it's more of the macro play is the better positioning and easier to try to predict, where if we go another leg wider and you start to have single company credit concerns, then those who have near-term maturity considerations, such as a Ford, that have capital markets issues, but that's much wider in spreads from 300. You're talking 500-600 basis points in high yield for those things to begin to surface.
Okay, and Craig, I noticed some people in the chat this week were talking about India versus China. That's really reversed dramatically, India versus China. And we're seeing some people starting to actually take China down and go back to India, because India has cheapened dramatically relative to China. Any other trends you're seeing? I think you put out a piece this week in the Lens on coal names, right?
Yeah, I mean, one of the things that we're seeing is some of the Trump trades into the election and into the end of the year that had done incredibly well have become more like fallen angels to start the year, and it's one of those better to have traveled than to have arrived scenarios, particularly for coal.
A whole bunch of tourists coming in, the tourists get off the bus, they pile into the Trump trade, and then they get hit with the surprise.
Yeah, that and the coal stuff had some idiosyncratic things going on, was kind of stuck in the tariff wars, and so right at the beginning of the year, the sector sold down pretty aggressively. But look, I mean, when we picked up some capitulation buy signals on some of your indicators, and Trump is in the promises made, promises kept type mentality, and it seemed to us that I suspect some of the big donors, coal guys, have been Trump supporters for quite some time. Probably put some calls in. And over the course of the last 2 weeks, we've seen 3 different announcements from 3 different secretaries, Energy, Interior, and the EPA, all coming out with rulings in favor of the coal industry over the last couple of weeks. So, that's the type of thing. Value without a catalyst is painful in this industry. But when you start to pick up some of these incremental catalysts, we start to get interested. And so, yeah, we put out a piece on coal, CNR, Warrior. What's that?
Anybody that wants a piece, it's Tatiana at thebeartrapsreport.com. It's called The One Idea, Craig Shapiro, Larry McDonald. And you can pick up this one idea by emailing us. And the names are Core Natural Resources, Warrior Met Coal, BTU Peabody.
Yeah, that's right. There's also an ETF, which is a little less liquid, but it's coal is the ETF. So But it's just an interesting kind of counter trend move, and it fits in the theme of domestic U.S. infrastructure, energy build out, transition from big tech into hard assets, which is something we've been pounding the table on for several months now.
Yeah, we're finally getting this. The gold miners are outperforming the S&P by, I think, 25% over the last year. And you got a breakout in gold. Another thing we saw this week, Craig, we had a number of funds talk about a rotation out of gold into silver, because that gold-silver ratio is broke the trend. And at this point in the cycle, you most likely get outperformance of silver relative to gold, because typically you have the mothership gold, the commodity leads, then gold, large cap equities, then gold, small caps, what we call juniors. And then the next stage of the trade typically is silver, and then silver juniors, which we're starting to see spectacular outperformance there this week. I don't know if you have any slides, Jose, for that. Yeah, Craig, what were people saying in the chat around that move in gold and silver?
Yeah, look, I think the key from here is how close are we to getting an incremental set of liquidity, right? I mean, the gold market anticipates liquidity, but as we get even closer to a liquidity add from the Fed, then that's when silver starts to outperform. So I think the question is, are we close, or are we about to take another leg down because the Fed is really unable to provide liquidity right now? And I think that's the rubber hits the, that's where the rubber will hit the road. I mean, from my perspective, I think it's too early for the Fed to be providing incremental liquidity, because the uncertainty is coming from the administration, right? And so the Fed wants to have more certainty so that when they deliver the liquidity, there'll be more bang for the buck. If they deliver liquidity into a continuously uncertain environment, it's going to do nothing. And so they need to kind of wait here. And I think that's part of the issue that the market is wrestling with, saying, okay, we've had this first leg down, sentiment's starting to roll over, soft data is rolling over, maybe the hard data rolls over. This is time for the Fed to come in, but the Fed is sitting there saying, we have no idea what the tariff regime is going to look like. Inflation expectations are through the roof. We saw that again, this morning with the UMich survey, but even in the prices paid indicators of regional PMIs and overall PMIs, people are concerned about forward prices being higher. And so the Fed kind of has to sit back here and let this play out a little bit in order to, bring inflation back down. And so if that's the environment that we're in, there's no Trump put here, there's no Fed put here, another leg down in risk, could really transpire here over the next couple of weeks.
I'm really proud of you, Craig. It's 3 Fridays ago we talked about the Trump. Just 3 Fridays ago, we pounded the table. The Trump team wants lower yields. They want to, like you said, like I think Lauren said, the top 10% are almost 50%, 60% of consumption. So you got to get asset prices down to really take down inflation.
Yeah. Look, I think, and one thing that I think we do well is I think we're good at picking up narratives, right? We're good at understanding, being early to the narratives, and then figuring out, well, how much has the narrative, come into the market. And so a few weeks ago, this idea that Trump was trying to slow the economy, bring stocks down, bring inflation down, bring yields down, that was a new. I don't think we were the first people to talk about it, but that was a newish concept. 3-4 weeks later, that's pretty much a consensus view right now that this is part of the administration's plan to try to slow the economy. Trump, Besson has talked about a detox period. Trump has talked about a transition period. So the administration is talking about it too. So the question is, what's the next move? I think there is a view that the administration won't tolerate much more pain. And so you're seeing a bounce again today in equities, off some key technical levels, maybe some relief as vol comes out, but I'm still a bit more concerned. I think the administration is going to keep at it, not really rapidly trying to slow this down. And with April 2nd right around the corner, I think that's at least for them an opportunity to try to set the record straight. Reciprocal tariffs will be with us. There'll be some certainty about policy at that point. We'll see how the markets react. We'll see how the companies react, and then from there, I think we could bring about some more of an understanding of how much the administration is willing to let this go. But that's still 2.5 weeks away. So I'm not so desirous of chasing a move up in up in stocks today.
And then we, on Christmas Eve, the Nasdaq 100 was worth $27.2 trillion. 27.2 trillion. This week we got I think right around 23. So a lot of money has left the NASDAQ 100, or that's also about $1 trillion left in NVIDIA, or was lost in NVIDIA alone, right? And so what we saw is with passive, a lot of that capital moved over to Apple. And so for a while there, Apple was holding up. Now Apple's given way. But at the end of the day, the point we make in our book, How to Listen When Markets Speak, is that we're probably heading back to that 1968 to 81 portfolio where global equities, global value outperform, companies that own hard assets outperform. And this year, that's starting to work. There's still a lot of people that are in the 2010 to 2020 portfolio where you're just long the same growth stocks. Whereas this year, we're starting to see a big move in, as we've been noting every single week, a big move into global equities and metals and miners and copper names. And that portion of the market is still extremely small relative. Like in 1980, 49% of the S&P 500 was in materials, oil and gas, and industrials. So 49%. Within recent years, that got down to 12%. Are we going back to 49? No, but are we going to 2025? Possibly yes. And so that's one of the big themes. Guys, in closing, anything you want to add in closing for the week, Lauren?
Just one thing on the high yield market. The high yield market is still slightly up on the year. Unhedged with the for example, the HYG. So the real selling in credit, I think it's still not here yet.
Yeah. I mean, you can you can still short credit, and we're nowhere near. And that's the point of the call, right? Is that in recent years, credit's always led equities, and that's why the one takeaway from this Lens podcast is that in the next couple of weeks, you want to get into our chat, get into the Discord room. If credit starts to underperform, we're going to have higher lows in equities. So far, the drama's been equities, right? But if credit starts to underperform, then most likely you're going to get lower highs in equities, and you want to be selling the rallies like we were in 2022. Whereas if credit outperforms, then equities are probably going to be okay. So
yeah, it'll be a stabilizing feature.
Yeah, and
for equities.
Yeah, thanks very much, guys. Craig, I'll see you next week. Join us, Tatiana at thebeartrapsreport.com. And if you want to get into the Bloomberg chat or the Discord room, if you want to get a copy of the Lens, the One Idea. Have a great weekend, guys. We'll see you next week.
Thanks, Larry.
If you're interested in any of the reports mentioned all throughout this video, or you want more information on our subscriptions and research, please email Tatiana at thebeartrapsreport.com. As you can see here on the screen. Many thanks for joining us, and I'll see you next week. Bye.